Hello YouTube, it's the accounting tutor here and we're back for another video. This week you're in luck, or probably not in luck, because you get to see this ugly face on video as well. So today's video is going to be on what is equity. We've covered off assets and we've covered off liabilities in two separate videos already. And the last bit of the accounting equation now is equity. So if we look at a set of financial statements, equity is usually at the bottom of those financial statements. It's made up primarily by share capital, share premium, retained earnings, and other reserves. And we'll go into all of those areas normally that we see in a company. We'll also cover off equity within partnerships and within sole traders as well. So what is equity? How can we define it? Well, for this we need to go back to the original accounting equation. Assets equal liabilities plus equity. Now, if we rearrange that, equity equals assets minus liabilities. And that's quite important because that's the basis of the definition of equity within IAS 32. So as per IAS 32, an equity instrument is any contract that evidences a residual interest in the assets of an entity after deducting all of its liabilities. Okay, so the key bits there is, it is the residual interest in the assets after deducting all of the liabilities. And we've already said that equity is assets minus liabilities. So it's what's left over after stripping out all of the liabilities in a company. Another terminology for this is net assets. So if we know that equity, which is equal to net assets, and we can see that if we go back into the example balance sheet above, and you can see the number in the balance sheet net assets there, and the balance sheet as total equity, that they're equal. So if equity equals net assets, let's understand what an asset is again. An asset is a present economic resource which is controlled by the entity as a result of past events. So equity must be a present economic resource of a company after settling all of its liabilities. So equity must equal the net amount a company owns or owes. And this can be in cash or otherwise. But in actual fact, who owns a company or who owns a business? Well, there are different people. So if you're a sole trader, then the sole trader owns the business. The owner of that sole trader is the business. If you're a partnership, it's the partners that own a business. If you're a company limited by shares, it's the shareholders. And if you're a company limited by guarantee, it's the guarantors. So, in actual fact, equity is the net amount that owners of a business own or owe, and that can be in cash or otherwise. Okay, so it's what owners of a business own or what they owe. And therefore, that's why we have so many different definitions of what equity is. So it can be owner's equity or owner's funds or an owner's deficit or owner's capital account. Or it could be a partner's current account or it could be shareholders' funds or shareholders' deficit, or stockholders' equity, stockholders' funds, or stockholders' deficit. There are many names for what equity is in total, depending on the type of company or type of organization that you're talking about. Now, there are lots of different elements that go into equity. We covered a few of them off at the start. So, share capital, share premium, retained earnings, other reserves, owner's capital, partner's capital, and partner's current accounts. So let's go through them as examples and see where we get to. So share capital. We're focused in now on corporations, on companies that are limited by shares. So share capital. When a company is set up, it distributes its shares to its owners. So in the UK, when a company is set up, it has to have at least one share, and that is given to its owners or its shareholders. Now, the shareholder will normally pay for those shares in cash. And if they do, what's the double entry around that? Well, the company itself has received cash, so it's debiting cash. And then it's got to credit something. And in this case, it's going to credit share capital. Why is it a credit? It's because the company actually owes this money back to its shareholders eventually. Eventually, this money will become available to its shareholders, and therefore it's in a credit balance. Imagine equity, like we discussed. Equity is amounts that are owned by the shareholders. So from the point of view of the company itself, it owes this all back to the shareholders. Therefore, it's a credit. You can think about it in that way, which will therefore make sense as to why it follows the same rules and principles as liabilities do. Because in the eyes of the company itself, it doesn't eventually retain this money. It's owed to the shareholders. Whereby the shareholder doesn't pay, it goes to receivables. So therefore, we go debit receivables, instead of debit cash, because we haven't received anything yet. And then we go credit share capital. But what's important to note here is that the share capital value is equal to the nominal value of the shares distributed. So the nominal value is the same as the face value of those shares. So let's take an example. If I set up a company and I have 100 shares that I start with of £1 each, and I distribute them and I pay £100 for those shares in my own company, then I have paid the nominal value of those shares, because the face value is they're £1 shares and there's 100 of them, so 100 times 1 is £100. And I paid £100, so I paid the nominal value. So the company is receiving cash of £100, so they go debit cash £100, and then they have to credit something of equal value, and in this case they're going to credit the share capital of £100. So just remember, for ordinary shares, a shareholder owns a share of the company and is owed a share of the total profits that that company makes. In addition to ordinary shares, there are also preference shares. Preference shares have no voting rights attached to them, so there's no control that a preference shareholder has over the company itself. However, what they do is give the holder a right to a dividend ahead of any ordinary shareholders. So they are preferred to any ordinary shareholders in receiving dividends. Now, preference shares are usually distributed to raise finance, because in a lot of cases, they are a combined equity plus debt element. So there's both elements to it. And I'm not going to go into detail on how preference shares work, but there's lots of different things you need to look at. You need to look at whether the dividends that are being issued are discretionary. So, the company can decide whether to issue them or not, or whether they're non-discretionary or compulsory dividends. So that there is an obligation of the company having to pay this dividend every single year. You then have to look at whether the dividends themselves are cumulative, as in any dividends that are issued and not paid keep piling up and up and up as an obligation of the company to pay out and as a right for the recipient to receive. Yeah. Or they're non-cumulative, which means that if they weren't paid, then they aren't added to another pot. They aren't added on to all of the previous unpaid dividends. And the shares themselves may be redeemable or non-redeemable shares. But all of that's a lot of detail, and we'll go into that in a separate video. But let's refocus ourselves on ordinary dividends. Ordinary dividends are the bread and butter of understanding equity. And so these are the shares that are distributed to shareholders that have voting rights, that have no right to receive a dividend. However, when dividends are paid out, they are normally paid out to the ordinary shareholders once the preference shareholders have their dividends settled. So that share capital, it is the amount of the distributed shares at nominal or face value. Now, what happens if someone pays more than the face value of the shares to the original company that these shares belong to? What happens if that occurs? Well, let's go through it step by step. Let's take the same 100 shares of £1 each, but let's say someone now pays £500 for those shares instead of the £100. Well, we know from what we previously spoke about that share capital has to be the nominal or face value of those shares. So the nominal value is still 100 shares of £1 each, which equals £100. Now we know we also received cash of £500. So receiving cash of £500 is a debit to cash of 500. And the credit to share capital is 100 because it's the nominal value of those shares. So what's the other 400? Well, it goes to something called share premium. And share premium is the difference between the amount paid for shares and what their nominal value is. Okay, so we paid 500, the nominal value is 100, share premium is therefore 400. Share capital and share premium themselves are non-distributable reserves. So we've covered off share capital and share premium. Let's remind ourselves of what equity looks like in a normal set of financial statements. So you'll see at the top, you can see share capital and share premium, and then you have a set of accounts in the middle and towards the bottom. The main one we're going to focus on is retained earnings. Now, what is retained earnings? Well, retained earnings is also known as accumulated profits or accumulated losses. Here's an example of a statement of changes in equity, which gives you basically an overview of the movements of all of the equity, of all of the reserves that make up equity. So you can see quite clearly here that retained earnings is made up of accumulated profits and accumulated losses. So these are all the historic profits and losses of the company. We can also see from this other set of financial statements that retained earnings also includes dividends that are distributed out or have been historically distributed out to shareholders. So we need to understand that Retained earnings is all of these accumulated profits, which are all is the net amount of all assets and liabilities, and therefore all amounts that are owed back to the shareholders. But before this year, there may have been dividend movements out of there already, and therefore it's the net amount after all of those dividend movements have occurred. Now, retained earnings can reduce in other ways as well. For example, if bonus shares are issued, then any amount over and above the amount that has been wiped out of share premium when making share premium zero goes to retained earnings as a debit balance. When share buybacks occur, retained earnings is reduced and a capital contribution reserve is created for an equal but opposite amount. In addition, if any premium is paid on the share buyback, then that premium element will go to retained earnings and not to the capital contribution reserve. And then you may see share-based payments as another example going through reserves, especially for subsidiary entities. So that's retained earnings. But let's also have a quick look at sole traders and partnerships. Both elements have something called capital contributions. These are amounts that the business's owners have put into the business. In the case of sole traders, this is called owner's contribution or owner's equity. And the way we deal with it, if it's a cash contribution, is we'd go debit cash because the company is receiving cash. We'd go credit owner's equity or owner's contribution. In a partnership, we call this partner's contributions. And you do a similar thing as you did for sole traders. You go debit cash, but this time you're going to credit partner's contribution. You then have cash distributions or withdrawals. These are when amounts are either distributed out or withdrawn from the business by its owners. In the case of sole traders, they're called drawings. And again, if the drawing is made with cash, then you're going to go credit cash because it's cash coming out of the business. And you're going to go debit the owner's equity or the owner's capital. In partnerships, they're called partners' drawings. And you're going to go credit cash and you're going to go debit partner's current account. The interesting twist in partnership accounts, though, and again, we'll come to this when we look at partnership accounts, is that salaries, commission, share of profits, and interest on any of the current account balances or contributions also go through essentially equity. They don't go through the P&L. So in that case, you're going to go credit cash and debit the partner's current account for those elements as well. I want to thank you for watching the video. Please, please, please hit that like button. Please hit that subscribe button. You can see that I'm starting to try and figure out different video techniques, but it's so incredibly poor. I've had to put these random boards in the background. Also remember, I'm on Podbean. You can listen to me as a podcast. I'm on Instagram as the.accounting.tutor. I'm on Facebook as the.accounting.tutor1. And please support me on Patreon if you can. And then I can advance my Photoshop skills and therefore you can see a prettier face than this. But thank you very much for watching the video. Take care.